What is up, you guys? Pete Carlo here, and today we're going to do video number 2 on liquidity. In the first video, we spoke about what is liquidity, why opportunity cost is important, what are liquid assets versus illiquid assets, and in this video, we're going to speak more about the stock market and why I really think that liquidity is one of the most important things when it comes to stock market. We're going to go over specifically the buy and the ask and the spread between it, which is called slippage. We're going to go over liquidity in stocks and liquidity in the options market. Then in a third video that's going to be coming out sometime soon, we're going to talk about non-liquid assets that I would invest in and when I believe there is a good time for you to be investing in illiquid assets. So I'm going to move my face out of the way and let's get started. So this is TD Ameritrade. This is a broker I use. It's one of my favorite platforms to use. Pretty soon you're probably going to hear the bell go off, so hopefully it's not loud. Overall, any broker that you use, there's going to be a bid and there's going to be an ask. This is extremely important. Now let's take a look at NEO. NEO is a great example of what a good bid and ask is. So we take a look at NEO. Now I have my level 2 set up down here. You can just click it there. Any broker you have will probably have level 2, I hope. And whether you're an investor or a trader, this is important. This is a little bit more important for those of you who are traders, but if you're an investor, this still is something of importance. Now you can see right here the bid, which is what people are willing to buy for, is $36.99. The ask, which is what people are willing to sell for, is $37. Now, literally, during the stock market, the bid and the ask is an auction. It's kind of like, you've ever seen Storage Wars when they're like bidding, like, you know, $5 over here, you got $24 over here, you got 20. Like, that is what's happening on an insane level during market hours. Now, after market, it's happening, but there's a lot wider spreads. We'll speak about that later. Now, with this is considered, that's not a bad deal. So let's just say somebody's selling a car for $3,000. You offer them $299. That's a $1 difference. It's not that big of a deal. You know, like, you can find a way in the middle and you're not going to lose a lot of money on that spread. It's not a big spread. Now, as far as NEO is considered, this is what I want to see. Because what ends up happening is, let's say you own a bunch of NEO shares and it says you're up $500. Well, your broker is going to show you what the ask is, what these shares are going for right now, what people are selling them for. But then you might go and sell a position, and instead of selling it for $37.03, you hit market and it sells for $37.02. And instead of being up like $450, you're up $420. Doesn't sound like a big deal, but when slippage occurs more is with stocks that have way less volume, like VEL, Velocity Financial. Look at this. The bid is $12.31. The ask is $12.38. So there is a 7-cent spread. Now let's say that you have $25,000 worth of this stock, right? $25,000, so 25,000 divided by let's see, $12.38. So you have 2019 shares. Now, right now there's a $10 spread. So you see that you're up and you want to sell. So you think you're selling it for $12.40 because that's what your broker's saying. But really, when you hit the market order, instead, you're losing 10 cents per share. So if we have 2019 shares times 0.10, you're actually losing out on $201 on this position. If you thought that you were selling, because your broker's going to show you, if you thought you were selling at $12.40, but really it goes through for $12.30, and that is called slippage. This happens on a micro level all the time, even with something like SPY. You'll see with SPY here, you know, there's a 1 penny off. So let's just say you owned 100 shares of SPY. You're going to lose 1 penny times 100. You might lose $1 when you're selling these shares. You're not going to lose $200 or $100 or $500. And with these smaller stocks that have less volume, that happens quite a lot. Let's take a look at something like SCX. This one, you know, look how bad this is. So this is $7.86 is the bid, and the ask is going to be $8.10. So it's like a 30-cent spread nearly. So let's say, once again, you owned, this is a cheap stock. So let's say you own 10,000 shares. 10,000 times 0.30 is $3,000. So if you own 10,000 shares, you might lose $3,000 worth of profits instantly when you go to sell, if you sell at a market order. Now, this is why I always sell at limit orders, because when you set a limit, like let's just go ahead here and I will go to active trader. I'll pretend like I'm selling. I hit edit, and here is where I would go to my limit button. And of course, it's different for every broker. And I would go ahead and I would see what level 2 is showing. Right now, the price average is 770. Now look at that. It wants me to automatically sell. If I just hit OK, it would sell it right there. As soon as somebody were to buy it, or as soon as somebody puts a bid in, it'd sell it right there, even though I think I'm selling at 826. So what I have to do as the seller and or the buyer is I have to find a price in the middle. So instead of selling at 770, I'm going to go ahead and I'm going to try to sell. And it's cool here, at least they have a scale to show you, like I'll meet somewhere in the middle. I'll try to sell for 780. But at the end of the day, I just might not get filled. Somebody might not buy that position from me, and then I'm stuck holding it, and then I don't have a liquid asset. Now, the first thing you're probably thinking to yourself is like, well, Pete, I don't have as much money as you think that you're using in these examples. You were talking about using $80,000 for this position if I had 10,000 shares. All right, well, let's look at the options market, because the options market is extremely important for slippage, and this is what murders so many people. Let's take a look at the S&P 500, and let's look at May 21st calls. So if you guys have no clue how to read an options chain, I do have videos talking about options chain, how to read this specific options chain. Just look up Peter DeCarlo options chain or go to the options section of this YouTube. Now, if we look, this is going to be our volume over here. This is going to be our open interest. Volume is how many shares were traded within a single day. Remember, we need volume. When I'm looking to trade an option, I usually want to see at least 500 to 1,000 volume minimum. Write that down. It's very important. The higher the volume, the less spread we're going to have. So let's look at this position right here. This is a May $422 S&P 500 call. This had 7,281 volume today. The bid, which is what people are willing to buy it for, is $400. So it's $4 times 100, because each contract represents 100 shares. So that's $400. Now, what people are selling them for is $4.02 times 100. So $402. So right here, I lose about $1 to $2 in slippage. It's not that big of a deal. $1 to $2 is not that crazy. Now let's go and let's take a look at, NEO, because NEO is going to probably be a decent example. All right, so let's look at NEO right here. So we're looking at these $37 calls for May 21st. They had 2,000 volume today. So the bid is what people are willing to buy it for, $1.61, and or times that by 100. So that would be $161, and the ask is $168. So notice a $7 spread. So if I'm trading 10 contracts, which is only $1,600, it's not a lot of money. If I'm trading 10 contracts, I'm automatically hitting, unless I just don't get filled. But if I want to get filled instantly, I'm going to automatically lose $70 right there, just getting filled. Now remember, this is both ways. I lose that money due to slippage on the way in, which is $7, and I lose my way out, which is $7. And now on top of that, imagine this is 10 years ago and you're paying a $10 commission each way. Automatically, just taking this trade, I'm down $40. Automatically. So right now, you can see there's a $7 slippage right there. Now let's look at something that has a lot less volume. Let's go to potentially something like BNGO. Because I think BNGO does have, yes, they do. They do have it. Or actually, let's just even go back to NEO. And let's go further out in time. Let's look at June 25th. This is a prime example right here. So monthlies are these gray ones that you see. Monthlies always have the most volume. But let's take a look at something like this. It doesn't have as much volume. June 25th. So if we take a look right now at this right here, volume was 61 today. It's a June $36.50 strike. Look at the bid, $315. The ask is $350. So that's $35 automatically per contract. Let's say I buy 10 contracts. That's $350 I'm losing to slippage coming in. And then when I sell, I'm losing to slippage coming out. So the less volume that we have, the wider the bid and the ask, the less liquid it becomes. Because here's the thing, you just might not even be able to sell it. sometimes you just won't be able to sell because there's nobody unless you hit the bid, and sometimes that can really screw you if you end up not being able to sell unless you hit the lowest price point possible. That tends to suck. I mean, if you look at something like this here, like let's look at potentially, let's go to like a BNGO, because I feel like BNGO is going to be pretty good examples. All right, so let's look at BNGO. Let's say that you held on to this BNGO call for August, and right now there is nothing. There's no volume. There's nobody buying this position in the slightest. You're just stuck with it. Even though you're very far out of the money, you're stuck with the position. Volume is the most important thing when it comes to trading options, and slippage occurs the most during options trading. Does happen with shares, but with options, it is one of the most important things. And this also goes if you're somebody who's a long-term investor and you like trading leap options. This is extremely important because let's just look at the S&P 500 one more time. And let's say that I'm bullish on the US economy, I'm bullish on the S&P 500, and I want to get a call for the S&P 500 for December of 2023. Well, let's look at this. I'm going in the money. Or right out of the money, I should say. No, we'll say in the money. So I'm going in the money, and I'm going to buy a December 15th, 2023, $420 strike. And look at the spread between them. $4,775. And the ask is $4,900. So right there, I'm automatically losing $225. Each way, per contract. Imagine if I had 10 contracts. So guys, use this information anytime that you're going to go ahead and trade options. In the next video, we're going to go over specifically the things that I look for when I want to, get into an illiquid asset, how much money I believe I need to have in the bank, how my finances have to look. All of that's important because in order for me to go buy an illiquid asset, I need to make sure that I have cash sitting around in case stuff goes sideways. Guys, if you want to get access to every single trade I take live as soon as I take it, live stream with me and my team every morning for the first hour of market open, get access to our private Discord as well as our 60-hour course library, use the code Academy90, start for $10 your first month, link down below. I'll see you guys next time. Peace.